Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. If your team is still chasing down the latest version of a chart, table, or portfolio, it's time for an upgrade. YCharts just made collaboration way easier with enhanced sharing. Now you can instantly share charts, tables, portfolios, and dashboards across share groups, keeping everyone on your team on the same page without the endless email chains. And since time is money, YCharts now lets you export data straight from your dashboard modules with just a couple of clicks. No more copying, pasting, formatting, just a faster, cleaner workflow so you can spend less time wrangling data and more time focused on growing your business and strengthening client relationships. Click on the link in the show notes to see why top advisors trust YCharts to save time and grow AUM, and get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them that Meb sent you. New customers only. Welcome, everybody. Today's guest is Peter Oppenheimer. Peter is the Chief Global Equity Strategist, Head of Macro Research for Goldman Sachs. He's been a leading authority for clients on issues shaping financial markets for over 2 decades at Goldman. He's also the author of Any Happy Returns, Structural Changes in Super Cycles and Markets, which explain how cycles help explain investor returns. Peter and I are going to walk through the history of markets, apply his ideas to the world today, get into all sorts of fun stuff. Peter, welcome to the show.
Thank you so much. Great to be here. Thank you, Meb.
You got a new book out. It's like my ideal book because I'm a visual learner. It's chock full of charts, tables, a lot of quant nerdery, which I love. But you talk about something that I feel like is like a little bit of a blend of quant as well as a little squishier because it involves emotions, but you talk about cycles. And I thought it was super interesting because you describe 4 phases of the equity cycle, and you didn't use the words recession, expansion, contraction. You used the words despair, hope, growth, and optimism. And I imagine that was a very intentional choice. You want to talk about the cycle and kind of why you use those words to describe it?
Yeah, no, absolutely. I mean, I should say for context, I have 2 books. One of them is focusing very much on cycles that link economies to financial markets. That's called The Long Goodbye, BUY. And the second one, the more recent one, is called Any Happy Returns. And that really focuses a little bit more on long-term structural changes, not just in economic factors, but also geopolitics, technology, social attitudes, and how they affect markets. And a lot of that is very relevant, of course, to today. But looking at cycles first, it's worth emphasizing that if you take very long-term data, there does tend to be a pretty good relationship between cycles in economies and cycles in financial markets, like equities. If you go back to the middle of the 19th century, there have been about 35 recessions in the US, for example, and roughly the same number of bear markets in the US equity market, bear markets being periods where the stock market has fallen by 20% or more. And there's a link between the two, because in the end, you tend to get a bear market in equities because investors are anticipating a potential recession. And in recessions, of course, profits fall, makes the value of stocks less attractive, and they correct. And then you get recoveries. So there's a definite relationship between the two, and it's continued, in recent decades as well. If you look at the period since the post-war environment, there have been roughly 13 recessions in the US, and again, about the same number of bear markets. When you look at sort of equity cycles, to simplify things, in other words, a period where you get a fall around typically a recession, but not always, and then a recovery, an expansion, and then typically a period of very high returns before you get a downturn again, those can, be split typically into sort of 4 distinct phases. And those are the ones maybe that you mentioned. So despair is pretty straightforward. It's the time when investors fear the most the impact of a potential downturn in profitability. And that's when you tend to get valuations falling as stock prices decline in anticipation of some kind of economic shock. The next phase, or the first phase of a recovery, is what we call the hope phase. And the reason I call it that is because it really is all about hope rather than reality. Equity markets are really all about trying to discount and anticipate the future. And nearly always that hope phase actually begins in a period where the actual data is still very depressed. If you look at the macro data, you're still in recession typically, interest rates may be high, but something triggers this sort of increase in animal spirits, this sense that maybe we're just getting to the worst part and things may still be quite tough, but getting less bad. And that hope phase is often where you get the biggest returns in equity markets, because you're going from the lowest valuations to a period of optimism that things are going to get better. That's when most of the returns that you're getting in equity markets come from rising valuations, not rising profits, rising valuations. PE multiples tend to expand. The next phase, what we call the growth phase, is the period during which you do get economic expansion. And alongside that, company profits tend to grow, dividends grow, and you're getting positive returns in the equity market. But overall, you tend to get slightly less returns because some of that has already been priced in and anticipated in that hope phase. But that growth phase is the longest phase. That's the period where you get sort of compound returns over, quite a long period of time, usually. But the final phase, I call the optimism phase, because nearly always, if you look historically, after a long period of economic expansion, investors start to get more and more confident that things can continue. And during that period, profits are still growing, but valuations start to go up again. And that sort of marks out, if you like, the last phase of a typical cycle. Now, obviously, these are labels that we put on looking at these patterns historically. No cycle's the same. They don't repeat themselves always in exactly the same way. You don't always get the same returns in each phase, but you can generally see repeated patterns over long periods of time. And that kind of construct, that framework is, I think, quite a useful way to think about things.
And you guys have a nice chart, a couple nice charts in the book. It's basically looking at PMI, ISM. And if I interpreted it right, and you're kind of doing the fractals, there's a level which is essentially so bad that the future returns are good, right? Where the ISM or the PMI is so low that, it's a great time, like kind of blood on the streets sort of market.
Yeah, and it's an important point to emphasize. But, often people think when things are really good and, economies are growing strongly, and that's got to be great for returns in risk assets. But often, actually, the best returns you get are when conditions are very bad. As you say, it's a bit of sort of blood on the streets. People have very low expectations, and that's reflected in very low valuations. People are very fearful. Stock prices typically would have fallen, but from the very low levels and very modest valuations, you can get very, very strong returns over quite a short space of time. So ironically, some of the best times historically to weigh into risk assets like equities is actually when all the data you're hearing and all the news you're getting is actually quite negative. And by the same token, one has to be slightly cautious when everything looks fantastic, because that's a good thing. But on the other hand, typically, good news is already priced in, at least to some extent, in markets like equities, which are all about really discounting future cash flows.
For the young'uns may not have experienced it. I mean, look, the global financial crisis, UK and US 10-year PE ratios were knocking on 10. I think the US on a month-to-month got to like 12 in February, March of 2009. UK was sniffing 10. So, periods where it feels like a career for most of us 15 years ago. But for, not that long ago, it's certainly relative to where the US is today, knocking on 40, totally different time.
It's an important point to emphasize because, of course, there was a lot of fear around at the time for good reason. Things were pretty bad. Banks were facing huge pressure. Economies were in recession. There was lots to worry about. But actually, for those that had the confidence and the foresight to buy, the subsequent returns from those lows over the next 10 years or more were spectacular and much stronger than long-term averages. So that, I think, underscores the point you just made.
Yeah, and how many, investors have we all spoken to that 2010, 2011, I mean, it went on till a couple of years ago for me where people said, I was just waiting until things calm down till I get back in, or I sold everything, I couldn't take anymore, and I never got back in. And as mentioned, some of the best times in markets happen on those sort of rebound periods, and it's tough to miss out on. One of the problems, Peter, with writing a great book is you're going to forever be asked similar questions, and you probably know which one's coming, which is, all right, we got these 4 stages of the cycle. Where are we at today? You got to give us I'm sitting here in LA, so where we at is US, but you can give me your perspective on across the pond too, how y'all feeling over there.
Let's take the US. It's the biggest stock market in the world by a very large margin. I would say we are in an optimism phase. The reason for saying that is because the economy is growing and profits are growing, typical of the more mature parts of a cycle, but valuations are going up as well. And, it's important, again, to think of things in context. The last couple of years has been one of the strongest sort of 2-year periods that we've seen in US equities going back over nearly a century. And particularly so in the period after around October of 2023. So, 15, 18 months ago, that was when investors really started to first get more confident that the surge of inflation and interest rates that followed the pandemic was reaching a peak, and that potentially we'd start to see inflation coming down, interest rates moderating, and more confidence in the economy. And from that point, equities had a huge charge upwards. And then in addition to that, of course, other narratives came into play, particularly around things like technological innovation and AI, which have really pushed up the returns in some of the biggest dominant tech stocks. So over a 2-year period, we've had an amazing return. Now, unless we get a recession, and it's not our view that that's very likely in the near term, we may get some kind of correction in equities, but probably not something more severe. But we do have to acknowledge that a lot of good news is being priced in. And to your point, Meb, US equity valuations are unusually high at the moment. Now, that may not tell us that we're about to see a fall, but it probably does tell us that, you're going to get lower returns from here over the next few years than we would have had, for example, coming out of that period during the financial market crisis when valuations reached such a low level. So I would say we're probably in a bit of an optimism phase.
But, plenty of other places around the world, as mentioned, it hasn't been this 15-year romp and stomp like we've had in the US. I mean, if we look at even valuations for both foreign developed and emerging markets kind of across the board, and they're all different. You have things like India, which has done really well, and China, not so much the past few years. It tends to be more of a mixed bag. Does that feel accurate, or how are you thinking about the rest of the world?
I think that another very interesting development, I mentioned that all cycles repeat themselves in the same way. Another very interesting development that's occurred since the financial crisis. So we're talking, roughly over the last 15 years, is that equities as an asset class have also become very, very much more concentrated. And this has really taken 3 forms. It's been the dominance of the US equity market, which has grown relative to other equity markets. It's outperformed consistently for many years. Secondly, technology has grown in prominence in stock markets, particularly in the US. It's become bigger because it's, again, achieved stronger profit growth. And thirdly, and especially in the US, the stock market has become very dominated by a smaller number of super large companies. So, the biggest 10 stocks in the S&P are, well over a third of the value of the whole index. 5 companies are getting on for 30%. That's a very high degree of concentration. Now, it's important to emphasize that all of these things have happened for good reason. The US has outperformed for many years because it's seen more profit growth than other regions like Europe or Asia. Part of the reason for that superior profit growth is that technology is a bigger sector in the US than in many other markets. And some of the dominant technologies we're seeing unfolding are really being innovated by super large US companies, and they just don't exist, or they don't have competitors in other parts of the world. So the US has outperformed for many years for good reason. It's just outpaced and outgrown from a profit perspective other regions. So is the technology sector. So have these companies. But on the other hand, what that has left, again, is a big valuation gap between the US and other markets. So you asked me about this side of the pond. If you look at the UK, you look at the rest of Europe, the gap of valuation, let's say on a price earnings ratio basis, is about 40% between Europe and the US. And that's a record wide. Now, it's reflected again a long period of much weaker growth in Europe and more longer term structural problems than the US has. But again, it has created a bit of an opportunity. And interestingly, actually, so far this year, and we're talking about, relatively early days, Europe and indeed some other markets have been outperforming the US, partly because, again, so much good news was priced into the US equity market going into the beginning of this year, and so much pessimism was priced into other markets. It's created a bit of an opportunity for investors to broaden out and to diversify a little bit more geographically, and that's one of the things we've been recommending.
You guys have a chart that I think would be a big surprise to all the investors listening or watching, which is the European banks since the beginning of 2022 have outperformed the Mag 7 stocks, which I think if you were to ask people, they'd be like, no way, that's not possible.
No, it's an extraordinary point to make. And the reason people would say no way is because rightly, there's a lot of focus on the Mag 7. These are much, much bigger companies and, have more impact on the global economy than European banks do. And they have been hugely successful from a profitability perspective. But European banks have for a long time been very, very poor performers, particularly in the aftermath of the financial crisis, because the banking sector was really the epicenter of that crisis. And many banks in Europe, as well as the US actually, had to raise capital and de-lever, take out risk from their business models, cut dividends, and they had a long period of very weak profitability. In Europe's case, that was compounded by a long period after the financial crisis of not just zero interest rates, but negative interest rates. And that meant that banks that typically make money by borrowing at one level of interest rate and lending at a higher level, there was no interest gap for them to generate profits from. So they had a very long period of very, very poor returns, but they got extremely cheap as a result of that. And again, this is an illustration of why valuation does matter a bit, because when the fortune started to improve for them, largely as interest rates actually finally began to pick up in 2022, they started to become profitable from a very low base. And then they began to be able to pay dividends. And, they've had a period of much better prospects. And so their stock value performances have been very, very good from a very weak base. So they've nowhere near performed as well as the big tech stocks in the US if you take a 10 or a 15-year period. But if you take a 2-year period, they've done actually very well. And so I think this again illustrates that while there's a lot of focus, understandably, on domestic stocks in the US and some of these hugely dominant and massively successful and influential US tech stocks for good reason, there are actually other opportunities in other markets, which often go a little bit beneath the radar because they're smaller and often not really on people's targets. But it does, again, I think, emphasize why diversification across equities geographically and even across sectors can actually generate some better returns on a risk-adjusted basis.
As you were talking about concentration, you got a really fun couple charts near the end of the book. One is, and we'll put this again on the YouTube video, the largest company in the index has historically belonged to the dominant sector. So not surprisingly, 70 years ago, that was GM, all the way, AT&T, IBM, Softy, Exxon, Apple, of course. But then you have sort of the by decade. And also, like, there's the by decade globally. And that's super fun to look at because, like, in the 90s or late 80s, I guess the end of the decade in the 80s, you would have had a ton of Japan.
Yeah, absolutely. I mean, again, very good point, Meb. People forget that, in the 1980s, there was a big bubble in Japan, and it was generated largely by speculation in real estate. Property prices went to extraordinarily high valuations, and banks, which were lenders to them, did amazingly well. And for a brief period, actually, the Japanese stock market was bigger than the US stock market in that period. It had a higher total value. And then when that bubble burst, and it did so very dramatically, you went into a very long period, 25 or 30 years of significant underperformance of Japan, both economically and in terms of its market, and very, very poor returns. But again, that's partly because it got to a point where the valuations became excessively high. And when the property market finally collapsed, it took the stock market and the banks down with it and generated a very, very poor return for a very long time. But yes, many of the biggest stocks in the world in the late 1990s were Japanese banks.
So you wrote this new book. What was the bridge? What was the reason you kind of like, it's a little slightly different focus? There's some other topics I want to get into in the new book. But as you were noodling, were you writing it during COVID?
The first one, actually, it came out just around COVID. So it was a bit of a strange time for all of us, of course. That was the long goodbye. And then, as I said, that really did focus on a lot of the relationships between economies and equity markets and the cycles, what triggers them, how you can anticipate them, the different phases, the sorts of returns you get through the cycle, what assets do better, what assets do worse, and so on. And then I felt that, there were some very interesting things to say, not just about cycles, but longer term structural changes as well. And that was really the focus of my newer book, Any Happy Returns. Because if you look at equities over the very long term, they tend to perform better than most other asset classes. They're risky assets and they have their returns somewhat linked to economic expansion, because that's what drives profits over time. And over the long run, equities have made good progress and good returns. But actually, when you look at it, other than having cycles up and down, you also tend to have epochs or phases, long phases sometimes, where you get unusually high returns sometimes, and that can last for a decade or more, and other times where equities make, on average, much lower index returns, but you have a wider trading range, so bigger cycles within the period. And what I was really trying to, I suppose, investigate is, why do you get these very different epochs? What causes it? Is it about the economy, or is it about a more complex collection of factors? Geopolitics, regulation, societal issues, technological changes, and so on. So it was really an investigation of what drives these longer term phases, what's explained longer periods of better returns or lower returns, and then a discussion, of course, about what I would call the postmodern cycle, or the sort of epoch that we're in at the moment, which has some of the elements of some of the most successful periods of high returns in the past, but it also does have some elements that have been associated with periods of lower returns. And so I was trying to sort of tease those out and understand potentially where the opportunities may best lie.
Well, I like your comment. The visualizations on some of these fat and flat was a good way. It stuck in my head, and so I'm definitely going to use that. So, what's the answer when you look through these? Did you find any gems? What was the secrets to us figuring this out?
Let's sort of unpack it a little bit and try and give some sense of what I mean by longer periods of good and poorer returns and why. Obviously, we can't do full justice to all the complexities of these historical periods, but let's go back to the period since the Second World War. The first phase, which was a period of very high returns, a secular bull market, as I would call it, really started from just after the Second World War through to the late 1960s. And, if you think about that period, there were a lot of things that generated very high returns for investors. You had, obviously, a period of very strong economic growth that followed the Second World War because you had the Marshall Plan and post-war reconstruction. You also had a baby boom that led to a rapidly growing population, at least in most rich or developed countries. And that eventually led to, by the 1950s, a consumer boom. There were big technological changes, the introduction of things like color TV, and in medicine, even things like penicillin, that was only really first used in the Second World War and then developed significantly, drug discovery after that. And it was a period of global integration. The post-war political infrastructure was really built in that period. You had the gold standard, you had the World Bank, the international, the IMF, and all of those sort of things. And that led to, from a very fractured world, a period of, if you like, globalization or integration. And the combination led to strong growth, strong returns. Now, it really came to an end in the late 1960s because, as a function of things like debt financing for the Vietnam War, and then later, by the early 1970s, the first of the big oil shocks, inflation started to rise, pushing up interest rates, forcing a recession. And that led to a very difficult decade for financial markets because it was one where you have very low growth or recessions, coupled with very high interest rates and inflation. Terrible combination, really, for financial returns. But it was also a period where you got a lot of geopolitical tensions, where world trade growth actually slowed again. You saw a lot of increases in taxation and regulation. And, as a result of that, you got poor returns. The next phase, and again, you can see how some of these conditions combine to trigger the phases in the market. The next phase really started in the early 1980s, and that's when interest rates peaked after the inflation of the 1970s. And in the US, as an example, difficult to believe now, but interest rates got up to the sort of mid-teens, and inflation as well. So very, very high inflation and interest rates. You'd had deep recession, the hollowing out of manufacturing in the US, for example, high unemployment. But from the early 1980s, things started to begin to improve. Inflation started to come down. And then alongside that, interest rates began to moderate. And that started a long phase that's really continued all the way through up until the pandemic, when they got down to roughly zero in most countries. So that was a tailwind, falling inflation, falling interest rates. But it was also a period where you got a lot of economic policy changes. The Reagan administration, Thatcher in the UK, and others that followed brought in a lot of deregulation, privatization, all of which helped to improve returns in the private sector. And then importantly, by the late 1980s, a seismic geopolitical event, the collapse of the Berlin Wall, within a short space of time, the Soviet Union. And that reduced military spending, it reduced global uncertainties, and indeed started the modern era of globalization as countries started to integrate their labor markets, and also a big increase in trade. And not so long after, countries like India joined the World Trading Organization. And then, of course, by 2000, just after that, China had. So this was the era of falling interest rates, strong growth, globalization and integration. And then, I could go on, but the period after that, of course, was, marred by a lot of crises. You had 9/11 and the wars that followed that. You had falling interest rates, then a brief and strong recovery that led to the financial crisis. We discussed that a little bit earlier, and eventually came out of that strongly, only to several years later hit the global pandemic and so on. So you've had a series of major shocks that have impacted markets and economies, since then. But very importantly, despite those shocks, because we had a very aggressive monetary policy easing, with global interest rates falling to zero or very close to that, and quantitative easing, printing money, that really helped financial markets to generate much better returns despite a very difficult economic environment. So it's a pitted history there of some of the big developments, but yeah.
Yeah, no, dude, we're big fans of economic and investing history here. If you could see behind on the bookshelf, there's lots of books on the topic. And in one of the, charts in one of your books, shows kind of the history of interest rates, but weird things going on. I mean, Chinese bond yields have been going straight down and Japanese have been going up. So it's like the upside down world we're living in today.
This is a great example, actually, of some of these longer term secular or structural changes. Now, China, Japan, the US, Europe, they have cycles up and down in their economies, but there are some very, very seismic structural events that take place. I mentioned after the Japanese bubble burst in the late 1980s, Japan went through a very, very long period of economic stagnation and deflation. And because of that, very, very poor returns in the equity market. It took 30 years or so to get back to the levels that the stock market was at in the late 1980s. And it only surpassed that relatively recently. For much of that period, China was growing at a very, very rapid pace, roughly 10% a year, until it reached its, huge size of the economy, around the time of the pandemic. And it had inflation. But now you're starting to see a bit of a shift. Japan is finally seeing some inflation, wages are rising, nominal GDP. That means GDP, including inflation in money terms, has been growing, and that's helping profits to go up. But actually, China has been seeing more deflationary pressures, and that's been pushing bond yields or interest rates to a much lower level. And so China has actually been in a different phase in the last few years to most of the rest of the world, which started to experience inflation coming out of the pandemic period.
All these countries, it's so interesting, where you have everyone who experiences, and you've written about this, neuronomics, and people, how they kind of experience these events. And you'll see these studies where it'll show, depending on when an investor was born or when they started investing, Vanguard puts these out too, they have totally different equity allocations based on sort of like when they started because of their own life experiences. And you do the same thing in London and Japan and different countries around the world where, people say investing in stock markets, why would anyone do that? Stocks don't go anywhere. Or with interest rates, like you talk to my parents' generation and we start complaining about our, 5, 6, 7% mortgage, and they laugh. They're like, are you kidding me? Like my mortgage was 15% or something.
Well, context is everything, and experience matters a lot. And actually, I talk a little bit in my books about another very important factor which drives markets, which is sentiment. And sentiment and psychology and crowd behavior are all closely linked. And there's a big body of literature about this, of course. But the sort of psychology is very much a function of experience. So, of course, for example, in the case of the US, for many, many years, policy was directed to avoid the ghosts of the Great Depression. Whereas in, say, Europe, the fear was very much inflation and hyperinflation. Policy was very, very much for many years and still today really focused at trying to avoid any kind of inflationary pressure. So there's a sort of national consciousness that reflects particular experiences of one country or continent relative to another. And then, of course, there are generational experiences because people who were brought up in the high inflation period of the 1970s have a different sort of set of experiences which impact often their investor behavior relative to people in more recent generations who have maybe been brought up when interest rates have been extremely low, or indeed in a pre-digital period to a post-digital period. So I think apart from all of the things that I've discussed, the fundamentals of economic activity and policy, of geopolitics, and of technological innovation, there's also psychology, which is a very important function of what drives markets.
That's the fun, but also the hard part of investing, right? Is, our entire evolutionary biology has trained us to learn from experience. If you go chasing the tiger or the tiger jumps out and you don't do anything, like your lunch meat. And so the same thing with markets. Like if you have this experience where you're like, no matter what, you should buy the dip every time, over the past 10 years, whatever it may be, because the market only goes up 15 to 25% per year. Like that's the lesson you've learned. Then eventually you have a big fat bear market, whether it's 20, 50, 80, whatever it is, or you have a long period of flat or just a totally different market where you have super high inflation, whatever it may be. Like your experience doesn't prepare you for that.
Yeah, and you mentioned earlier, Meb, the financial crisis, which seems like ancient history now. It wasn't actually that long ago, but the US stock market, for example, fell about 55% from its peak in 2007 to its trough roughly in 2009. I mean, extraordinary declines. I mean, that had a very, very big impact on psychology, understandably. And of course, similar episodes we've seen in previous periods. By the way, when the technology bubble burst in 2000, this was the period of exuberance around the innovations that were generated by the commercialization of the internet. Many tech stocks, even some that are dominant today, fell 80, 90%. And many people after that didn't want to touch technology stocks because they were seen to be so risky. And again, great opportunity. I mean, obviously with the benefit of hindsight, but to the point we were discussing before, when you get great companies that fall for whatever reason and the valuations really decline, that can be, if you have the confidence and the wherewithal, a great buying opportunity. But by the same token, we should be a little bit cautious when everything seems wonderful. And, much of that psychology, if it exists, is reflected in valuations at times when markets are very high.
Speaking of valuations, again, you got a great chart in the early part of your book. And this is an interesting one because I feel like everyone loves to talk about valuations, and investors always want to magically time markets. Their goal is to just pick the top, pick the bottom, be a totally binary experience. But you have a nice chart where you talk about valuation and below the 30th percentile, and it's looking at stocks, average forward returns for a year and 2 years. And so normally people are like, you can only use this for 10 years, whatever. But then the hit rate, so the batting average of, how often the years are positive. And I thought this was like pretty interesting takeaway. Maybe talk to us a little bit about, thinking about valuation today and how that may inform what the heck's going on in markets.
The interesting thing about investing is that, in a sense, we're trying to anticipate what might happen in the future. And the truth is, nobody knows. we can gauge and judge and make, we hope, educated assessments, but nobody really knows. Some things that we do know are the things that you can observe today. You can observe today how markets have moved in a recent period, and you can observe today the current valuation. So there's information in that because it is observable. And, valuation doesn't tell you everything, but it is a useful guide. And it's a simple adage, but one that shouldn't be entirely ignored. When valuations are very high, the probability is you're going to get lower returns into the future than when you buy when valuations are low. Now, timing is everything, of course, and you can buy cheap assets that can remain cheap for a very long time. And indeed, you can be invested in expensive assets that are expensive for very good reason and can outperform and do very well for a long time. But over the long run, there is at least some information about the risk-reward profile when you look at valuation. So it's just to say that, if valuations are very high, doesn't mean to say that you have to sell everything and be out of the market, but you should be at least expecting that you will get lower returns than in periods where the valuations are lower, particularly over longer term holding periods. So it's just one of those things to be aware of, really, and also to think about how you can diversify at times when valuation of assets are high in order to reduce the potential risks.
Well, diversification, that's such a great topic, and we'll get into that. The good example, listeners, on the practical side, like you think about it. So let's say you're like, Japan, let's say you're in the 80s and you're like, this is crazy. This market's a bubble. It just hit a PE ratio of 50. I'm going to short it. Well, guess what? You got taken to the woodshed and lost all your money because it doubled from there. And said differently, let's say you're like, there's a market that's super cheap, single digit PE ratios. Everyone hates it. It's down 80%. And that's like the old investing joke. It's like, what do you call something down 90%? That's something that was down 80% and then got cut in half again, right? So then you go down another 50%. So it's never easy, but avoiding this temptation to go all your chips in on a bet because it's at extremes. Long-term capital learned this lesson years ago. The spreads can always get wider or crazier, or in the case of the oil future markets, even negative, right? So let's get to diversification, some opportunities today. You guys have written a little bit about, moving away from cap weight and other opportunities in a world of potentially fat and flat in U.S. market cap, or maybe subdued potential returns for some of the really expensive stuff. How do you think about returns? Should we be seeking out dividends and buybacks? Should we be seeking out value companies? Any sectors or industries in particular? How y'all thinking?
Well, I think the first principle would be that given we've had a long period of very strong returns across financial assets, it's been true in bonds and equities and credit as well, for that matter, probably diversification is becoming more important again. And you can diversify across asset classes, a bit of different things if you can, but also a little bit of, geographically, and a little bit across different sectors, industries, and even styles. Because as I mentioned earlier, we've had a very unusual and long period by historic standards of diversification not paying off, of the US constantly dominating returns in equities, technology being the main driver, and increasingly a small number of companies. So we would push back on that a little bit and look at some of the broader opportunities that may exist. And, I mentioned earlier on that there are big valuation gaps between the US market and some others. Those gaps have existed for good reason, because the US has consistently generated better returns and better profitability than other regions. And so it has rightfully a higher valuation. But where at the margin you're starting to see some improvements in other regions is probably creating a bigger opportunity set than we've seen for a long time. I would also say, it's kind of interesting with technology. We're seeing extraordinary developments and very rapid ones in technology, very exciting ones. But there's a couple of things that are potentially changing here, which are creating opportunities. One of them is that among the biggest technology companies, many of their successes in the last 10 years have come from being relatively capital light. In other words, not having to invest huge amounts of capital, but being able to leverage their products and scale them at extraordinary pace. Think of software or cloud computing or whatever. And one of the things that's shifting with AI is a requirement by these dominant companies to start spending huge amounts of money on capital, on things like data centers, on chips and so on, in order to realize their ambition for future growth in AI. And that means that the potential future returns they get on this higher level of capital invested may be still good, but less good than we have seen. So that's one thing. I think the second thing is that there's now a bit of a symbiotic relationship between the fortunes of technology and that of some other industries, which we haven't seen for a long time. What do I mean? Well, if you think about AI, we know it's hugely energy consumptive. So to really generate the future prospects of growth in AI, you're going to need to see much more spending on energy infrastructure, electricity generation. So some of those companies may benefit because they'll be part of the solution. We're going to need to see a lot of building in things like data centers and infrastructure, which we haven't seen for a long time. So that's broadening out the opportunities as well. And then I would say that, to the extent that we're getting real big breakthrough in some innovations in technology, in large language models and so on, as we saw with the internet, once you start to see a transformative technology broadening out in its application, where you get new products and services that could be developed on the back of it, then you get some great growth opportunities in new companies, some of which people haven't even thought about or haven't even started yet, or new products and services. So, let's take the internet age. When that generated a bubble in the late 1990s, people sort of got very excited about it because rightfully they started to realize that something really transformative was happening with a major new technology. But people at the time didn't really understand or fully anticipate what and how that would change economies and our lives and business models. But once you actually started to get the infrastructure rolled out, all our homes and businesses were sort of piped to connect to the internet. It was a little bit later, really, with the introduction of things like the smartphone in 2005-06, and then apps that created a new platform for lots of new businesses to establish scale at a very rapid pace, things like social media companies or platform companies or many others like this. And so I think we're at the dawn of seeing a real breakthrough where not only the dominant companies that are investing in AI, but many others that can provide new products and services are going to generate some really good opportunities for investors. And also some companies outside of the technology industry where they're either helping to build the underlying infrastructure, the energy, the data centers and so on, or indeed companies outside of the technology sector that can embrace and utilize these technologies to become much more productive. Let's say, for example, in the healthcare industry, it's quite likely that drug discovery will see a rapid acceleration with the ability to use large language models and data and process huge amounts of data very quickly and much more cheaply than before. So there are going to be opportunities in other industries as well.
You mentioned a little decarbonization topic too there with all we're thinking about. It's fun. Any other general themes? People love talking about themes, thematics going on as we look forward. I don't even think we've mentioned emerging markets at all on the podcast today. We may have mentioned China in passing, but what are some other themes or regions that are on your brain as we look out to 2025 and beyond?
Well, I think the emerging markets is not a homogenous asset class, but to the extent that these things do tend to have periods of better or relatively less good returns, there are a function of things like interest rates and the dollar. Typically, emerging markets do better if the dollar is weakening and if interest rates are coming down. So if we start to get into a phase where that begins to happen, I think returns will be a lot better across emerging markets. And some of them actually have started off quite strongly since the beginning of this year. And you mentioned China, which has had a period of very, very poor returns in its equity market in recent years, has actually seen quite a big rebound, and some of it in the tech sector, as people begin to think that actually, there are some very good quality leading companies in that space that have got too cheap. So, in terms of themes, I mean, I think one of the other ones, perhaps unfortunately, is that in the current geopolitical climate, we are seeing more pressure to increase spending on defense. Europe is in the focus here because with more encouragement from the US for Europe to take on more of its own responsibility for defense spending, it's having to rapidly move up its joint spending on defense. And so, defense companies are performing well, and we think that's a trend that probably, has further to go as well. So there's lots of sort of themes like that, which again tie into some of the technological developments we're seeing and some of the geopolitical developments as well.
China's an interesting one because if you look back to, the last 30 years or so, to the bottom, whenever that was last year in Chinese equities, I mean, there was darn near no returns. One of my favorite things of an investor is when you look at a market, and it could be anything, and be like, man, this hasn't generated returns for 10, 20, 30 years. US investors, you're forgetting about this now, but there's periods where US stocks have underperformed bonds or just underperformed in general for long periods. And you look at other countries, and usually that's what, kind of tying back to the beginning of our discussion, that's what sets the stage for the good times, right? It's not super technical phrase, but good times follow the bad and vice versa. And if you're looking at China, everyone was pretty, it felt like the sentiment was pretty bad on China last year. And then, here we are. I don't think there's any country over the past decade that's gone from like PE of the 20s. I think in 2007, they were at a PE of like 50 on the CAPE ratio, and then hit arguably the lowest or near the lowest that had ever been last year. So it's in your cycle, it's definitely been on both sides frequently in the past 20 years.
No, absolutely. And it comes back to the recurrent theme that valuations do tell you something. And when things are very out of favor, it doesn't mean to say that they're going to turn, but it's certainly warranted looking at, and again, having a broader spread, being a bit more diversified, can often pay off over long periods of time, at least.
Yeah, a lot of the big quants, love talking about things like the value spread, not just within the U.S., but across U.S. in market cap to foreign emerging, and then within those markets too. Is that something y'all think is interesting as far as kind of traditional valuation metrics looking appealing versus the market cap weight here in the U.S., or how do you guys think about that?
Yeah, I mean, the US equity market on many measures, if you look at it historically, is at a high valuation. Now, deservedly so, because as I said, it's not really a bubble. It's not speculative. It's gone to higher valuations and it's performed as strongly as it has because the fundamentals have really been very good. So it's worth emphasizing that this is not, if you like, irrational exuberance or some kind of fanciful, hope of the future. The US has achieved remarkable returns. But then again, if you compare it to very long-term history on most valuation metrics, you're into the sort of 90th percentile. So that means very high relative to the sort of historical averages. And that isn't so true in other markets. So I think that is something that we do take into account. Now, some of the reason that the US has a particularly higher valuation is because of this concentration, because the dominant companies have higher valuations because they're so profitable. If you look at an equally weighted index in the US, rather than a market cap weighted index, the valuations do come down. And that's another sort of descriptor or way of suggesting that actually a broader spread of returns across the market may be more attractive than they've been for quite some time. So it's the valuation gap would support that. Also, as we were discussing, while there's lots of exciting things, I think, for the large tech stocks and for the tech sector, we are actually at a point in time where you could see some of the advantages that these technologies generate spreading out into other industries. So that sort of feeds into this point about the valuation advantage in, a more equally weighted or more dispersed a group of companies than we've seen for some time.
You and I were talking before we got started about last time I was in the UK drinking pints in a pub during Brexit, and everyone was very despondent. And yet here we are a few years later, and I'm looking at one of y'all's pieces at the end of the year. And the title of the piece was UK Equities New York Calling. But there's the first exhibit is the UK. It says UK trades at an extreme discount to the US. Is this an opportunity? Is this something like I see this exhibit 4, and we talk a lot about shareholder yield on this podcast. So investors hear a lot about buybacks, and exhibit 4, buybacks. What's going on?
Buybacks are growing strongly in the UK. Dividends are growing strongly. And so the sort of cash return that you're getting, the cash yield, if you like, is pretty high. And that does suggest that there's an attractive case to be made. Again, it's very important to emphasize you can't really compare directly a market like the UK to the US because the composition of the market is different. There's no big technology company in the UK index, whereas the US is dominated by the biggest technology companies in the world, and they have a higher valuation. But even if you adjust for the sector differences, you kind of equalize those. The UK is quite cheap, and it is generating a lot of cash. So, again, it's part of what may be seen as a broadening opportunity set to diversify. Bear in mind the dollar is very strong against sterling, or indeed against the euro or most other currencies. So from a US investor perspective who is buying things, in dollars, you don't only have a cheaper valuation in other markets like the UK, but they're cheaper than would normally be the case anyway because the dollar is so strong. So that's interesting from a corporate perspective because you might get companies in the US looking to make some acquisitions or bolt-ons of companies, for example, in the UK because they're cheaper. And also from an investor perspective as well, where you might want to find some diversification opportunities.
Yeah, the sector adjusted. We got a couple charts on this. One is from Norbert at Taunus Trust that we'll post the show note links. And it's interesting because the different countries, different sectors, depending on what the composition is, it definitely changes the valuation relative to the US, sometimes in different directions. But it's fun to look at. So you try to be apples to apples. Peter, we only have you for a little longer. This has been super fun. I want to ask you a couple random questions. Doesn't mean they have to be short, but they're definitely just a little different. Let's say you go on a little cycle with your buds into the countryside. You guys stop for lunch, and this is a bunch of other peers. So CEOs, CIOs, investment world, portfolio managers. You guys stop for lunch or, maybe at the pub for a pint later in the day, and you guys are talking, and Peter says something, and it's a belief you hold that 75% of the people at the pub would not agree with you about. So it could be current, or it could just be like a foundational principle that Peter believes that is non-consensus in our world. Does anything come to mind that you might say?
A little bit along the lines that we've been discussing, because it hasn't been fashionable recently, or at least in recent years, where there's been, from a financial market perspective, very much a sense of US exceptionalism. I think, diversify, focus on diversification, because over the long run, that's going to improve risk-adjusted returns, which is what investors, I think, really also need to think about, not just the return, but how much risk you're taking to get it. And then I would also say, be patient and take as long a view as you can, because one of the great things about investment is time, because over time you tend to get the benefits of compounding, and compounding returns is extremely powerful. And it may not be something you can achieve in 6 months or a year, but if you can be patient and take a longer term view, I think that's something I would certainly emphasize over a pint.
What's been your most memorable investment? It could be good, bad, in between. It could also be, maybe your most memorable calls at Goldman over the years. Anything burned in your brain?
Because I do look at these very long-term signals and valuations and so on, together with some colleagues back in the late 1990s, we did get very worried about a bubble in technology because things were then just getting so irrational in terms of valuation. And it wasn't really about the story. As I said, in a way, the story was right. This whole technology was totally transformational in ways that were probably, in the end, exceeded what people had imagined at the time. It's just that prices started to get to levels which over-exaggerated the speed and the returns across all companies. So that was something we were very focused on. And I would say, a little bit on the other side, we didn't know, and I can't say we called exactly the bottom, but we were very much conscious and emphasizing at a time of the financial crisis how low valuations were getting and how high risk premium or sort of uncertainty was being priced into markets. And, and again, I think in some sense it's easier at extremes because you can observe these things. Difficult to go against the crowd, but it's easier to sort of see when things get very extreme. It's when they're in the middle, I think, it's much more a matter of, marginal judgment and luck, really. Yeah. And, I think it's very difficult, picking the top or a bottom of any market cycle or structural trend is very difficult, and you may be lucky or unlucky. But even if you can, recognize these inflection points some time around when they happen, it can really help a lot, because avoiding the worst returns, if you look at compounding returns over time, if you just avoid the really extreme periods, it can really boost the returns as an investor.
Peter, this has been awesome. Listeners, check out Any Happy Returns, also The Long Goodbye. Peter, thanks so much for joining us today.
I appreciate your interest, and I hope it's been useful for people.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.